Hi, everyone. Welcome to this episode of Beyond Max Q. I'm your host, Mollie Jahner. I am joined today by Jesse Witkowski, who is the CEO and co-founder, I believe, because Ella is your fabulous co-founder of DFX. And it's a community which, if everybody who's been following our community, it's hard to build community and it's hard to do it well. And DFX is rocking it. Clearly, they have thousands of members and they're connecting founders to funding. And so, with that, Jesse, please, if you wouldn't mind introducing yourself and telling us a little bit about what you're building.
Thank you, Molly. Myself, Jesse Witkowski, founder and CEO of DFX. Essentially, DFX Deal Flow Exchange. It's a global network of founders, investment sponsors, lenders, investors, service providers, and we're bringing them all together to do business in a much easier capacity, essentially allowing for a much faster top of funnel to be built and really set the stage of relationship building in general. So, the platform itself, we released in March of last year. We've scaled very quickly globally. We have thousands of using the platform. Bit about myself before DFX, ran a global investment network and was connecting people all day, every day to capital. Worked with every type of deal, worked with every type of founder, every type of investor, and realized that no matter what vertical you are working in, everybody is experiencing the same pain. So capital raising is very inefficient. It's very costly overall, and it really does not need to be as costly or inefficient as it is. Essentially, at the end of the day, two people from either side need to meet each other and start building a relationship. And the sooner that happens, the sooner capital can move from one side to the other. So on our platform, the platform is a piece of the puzzle, but also we hosted about 100 and something events last year. We have a ton coming up, and the whole idea there is that yes, there's a great way to meet people on the platform, but in reality, we need that connection. We need to bring people together, and so that's what we do. And we let them set the seeds of the relationship, and then take it off the platform. We don't charge transactional fees. It's a very low subscription model, and that way we can scale and snowball and build this network effect globally, which is unraveling right now.
I love the network effect. And it sounds like, 100 plus events. That's so many events. Can you talk a little bit about what it would look like to join DFX? Who should join? What does that look like?
Yeah, yeah. Anybody within the private capital ecosystem likely has a role in the DFX ecosystem where they can get a significant amount of ROI. So the platform itself, it's actually in the community. It's free to join. You can go to joindfx.com. It's the easiest way to do it. That'll redirect you to the platform, and you can sign up for free. If you want to list your opportunity on the platform, if you want to provide services to the network or engage with deals that are on the platform, average cost is $39 a month. So very, very low cost. Essentially, the idea there is you meet one person you can do business with, you're likely getting an ROI. Realistically, you're going to meet a lot, especially if you get involved in the events. And the more ROI that we can provide, the more that we can build champions out of everybody in the community. And then they invite their network, and then it is that network effect. And that's what we've seen. So the hardest time for our business was really when we had about 12 deals on the platform really early on. And we were telling people, how fast this would grow. And now today, I would say there's about 700 to 800 deals that are raising capital right now. We just closed a $50 million deal within the network 2 weeks ago, which is 2 or 3 weeks ago at this point. So that's great to see. And there's a lot of connection happening, a lot of business happening outside of just fundraising. And overall, we have our goals very high for this community. I mean, this is what we consider inning 2 of 9 from a growth perspective, and we're certainly winning the game, but there's a lot of game left.
Well, I like that. And I've actually been in a couple of these events and they are fantastic. So for our community, you should definitely check it out. Highly recommend joining. While I have you here, I would love, because you've been on both sides, founder and funder, I would love to get your perspective on, especially from the funder seat, because we don't often get the chance to interview funders. What are you looking for in a startup? How are you thinking about allocation of funds? I would love to get your perspective.
Yeah. Yeah. So A lot of this comes down to what stage the company is at. So let's talk early stage pre-seed seed because that's where the biggest struggles are these days. And part of that, just kind of the backstory of it, is there were a lot of VCs in the, say, 2020 kind of time frame, 2021, that when money was very easy to come by and valuations were stretched, they were able to do well in performance and then raise a second or third fund. And VCs are very incentivized to do so because they're charging fees on how much capital they have under management, right? So what has happened over the last couple of years is that the good VCs have gone upstream and now are funding Series A, Series B, Series C. You don't see as many VCs really contributing to the pre-seed and seed space. So this kind of question is more so from a funder perspective and from a startup perspective, it comes down to that match, right? So a lot of startups right now are having challenges raising capital, mostly because they're targeting the wrong audience. Angels are getting much more active. Family offices are certainly going into more pre-seed and seed rounds, and there's a lot of reasons for that. VCs are starting to kind of go upstream a little bit more. From a funder perspective, when we're talking about analyzing an early stage company, there's so much that is really the bet on the founder. There's a lot of founders think that their company is going to solve these massive problems, and it's the best company in the world, and that's great. That's a great attitude to have. The investors, what these startups and these founders need to realize is that investors are approached a significant amount of times, and they've seen hundreds or thousands of deals, no matter what kind of investor it is. Even angels have seen a lot of different deals. So the way for startups to and founders to really set themselves apart is to approach the fundraising side more so from a relationship building side. So when I'm looking at a deal, if a startup or a founder comes to me, I'm looking to see how they interact, how they build that relationship, if they really can, and if that's their goal, right? Because if there's a lot of groups asking for funding, right? There's a lot of groups asking for money. Um, as an investor, it's important to say, okay, I am putting my money with this founder because I believe they have this idea that they can actually grow. And part of that is, of course, the business model and the offering. But a bigger part of that when you're early on is actually if the founder has it in them to do so. And a lot of that comes down to relationship building, to grit, to having the vision and to be able to express the vision clearly. So from the investor side, I like to see people who practice it's called the 3 C's. So clear, crisp, concise communication. That's a huge one. If you can't communicate your message within 90 seconds as to what you're going to do and how it adds value, and really in that message, how big the problem is, you're going to have a really challenging time raising capital because most investors are not going to give you much more than that. It's kind of that first impression of relationship building. Um, the individuals that approach investors from more of that getting to know you standpoint and less of, hey, I'm raising capital, they seem to have much higher success rates, which makes sense. I mean, people want to do business with people. If somebody's putting money with you, that means they trust you with that money. How do you build trust, right? Foundations of a relationship. You have to build the trust of the investor. And generally, if you're asking for money right off the bat, that's a tough way to build trust. So I think that just seeing how a founder approaches it, seeing how they build the relationship, and seeing how they express their vision and clearly paint the picture of where their company is going, those are the investors that get certainly the most traction.
I would love to actually see, go back to the beginning too and say, okay, you're a founder now. If you're starting out with something, how would you approach getting funding, like day one?
That is a a great question. There are so many variables to that in terms of
Okay, okay. You're
how
you're
fast do I
building a
need
thing.
it?
You're building
Okay.
something tangible. We have a lot of hard tech,
Yes.
defense tech
Yes.
founders in our audience. You're
Yeah.
building a thing, and knowing what you know now, how would you look for investment?
That great question. Start sowing the seeds of a relationship with your target investor as soon as possible. Certainly get involved in local events and things like that where investors will be there, but don't ask them for money. Go to them and start building that relationship and see if you can meet them for coffee and things like that, and just find out more and more about them, because a lot of times too, the investors you meet are not your investors. They actually introduce you to investors. So it is that relationship kind of networking game where it's important to basically try to add as much value to everybody around you that you can, even if they're not your target, audience, or they're, not going to invest. Still try to help them, and try to open doors for them, see what they need. If you can help people help you, from a capital raising standpoint, get as much traction as you can. It really does help a lot. It really does show a lot. Also, if you speak with an investor and they say, if they say no, or you're just starting to communicate with them, give them periodic updates, every couple months or every couple weeks. Just somehow get in front of them how progress is going within your organization, right? Because as they see more and more progress, they're going to be more and more inclined to give you more of their time and be more interested. So it's not, whenever you're speaking with an investor, don't think of it as kind of a one and done. You need to pitch them right then. It's really about building their interest, building their attention into what you're doing. But I think that, if I'm a founder and I'm looking for capital, um, I'm going to not so much spray and pray. I think that that's something that has been taught a lot lately, and that's something that we, with our platform, are kind of approaching differently. We want the investors to approach the founders that they're interested in, as opposed to the founders emailing 100 or 1,000 people, because what that does is just inundates all the capital providers inboxes. It bottlenecks the whole industry. When you have everybody doing that, nobody can find what they need from their emails. So I would say, instead of this mass approach, fewer but very targeted connections are typically going, spend more time with the right people as opposed to spending time going all over the place. Talk to other founders in your space, build relationships with them. They sometimes will be able to open up some doors for you as well. And consider, depending on how early you are, from a funding standpoint, I highly believe in using safes, simple agreements for future equity. I think that they are a fast way to get funding. Um, you typically can work with the investor in a way that is, mutually beneficial. Another great way is to ask for advice. Don't ask for money, ask for advice. So find people who are really experts in your space who you want their advice. And also, a lot of those people will have exited companies in your space, and that's why you respect them and want their advice. So if you ask them for advice, you're much more likely to get money. And if you ask them for money, you're much more likely to get advice. So I would say something you can do is aligned incentives, where maybe they invest and maybe they also come on as an advisor. You give them some advisory shares as well. And that's a mutually aligned kind of system. It's something that I've, personally done, and also seen done very well, because they have skin in the game to also open up doors to other investors for you. And, when you're a young company, you feel like every 10,000, 25,000, 50,000 is so significant, and it is, to get the idea off the ground. But in reality, the advice that these individuals can provide is worth so much more. And so that kind of angle, always is, in my opinion, that's one of the best angles, is to bring on individuals who are so high level in your space, give them some equity in your company. I know that, as founders, we try to protect our equity as much as possible, but if it's somebody who really can be a champion for you, who also can give you possibly capital and also open up so many doors for you, um, you have to sacrifice a little bit to gain a lot.
No, I love that. And you mentioned exiting, which I think is important. I want to ask that too. You have so many deals on the platform. People are buying and selling, there's an exchange. What does it look like to get ready to exit from your perspective? And what do you think some of the things that successful exiters do?
Another great question, and deep, and it really is one of those kind of grandiose ones. So I think the ones that are successful from the exit standpoint, they have a plan, right? They already are starting those conversations throughout the life cycle of the company. Um, Exits and the due diligence on them and the completion on them, they take anywhere from 6 months to 18 months usually. And so they don't happen overnight at all. Um, and you have to think of what companies are looking for, right? So most there's a lot of private equity companies right now that are looking for cash flow positive companies that they can grow, right? And they can roll up. So if I was looking, and I'm not, but always happy to speak with private equity groups, but not certainly not looking as DFX goes. We won't exit. We're going to, from a private equity standpoint, we're certainly targeting the IPO. Everything we do is towards that direction. But as a company, I would want to stay in touch and stay on the radar of groups that typically are in that private equity space. There's so much going on in that roll up. We'll package 5 to 10 different companies up, and then we'll sell it to a much larger private equity group. So that kind of thing is happening probably more frequently than ever. So getting on the radar of the private equity groups that are active in your space are certainly the best way to exit. You don't want it to be a fire sale situation, so make sure that you have your books in order and make sure that you can continue to prosper without having this deal go through. Because I mean, a lot of times the deals don't go through. You'll spend 3 months, 6 months, 9 months on a possible acquisition, and then something doesn't happen, whether they don't have the funding or their due diligence gives them a red flag. And then all of a sudden you're out all of that time and all that effort and likely a lot of money. So I would say, also be careful with the exits. Be careful who you sell to. A lot of people, founders will exit and they'll be wrapped up in this company for another 3 years or 5 years, or even if it's only 1 year. But you're selling to a company that might not understand your culture. They might not understand, how you've been able to build this business and build these relationships within your business. And most of these private equity groups are highly focused on the numbers and might just completely change your company and your vision. So, from the exit standpoint, I would just say, make sure that the group that you are looking to sell to is the one that you believe aligns best with your vision. But at the end of the day, of course, dollars, speak very loudly to vision. So,
It's true.
to each their own, to each their own.
Yes.
But it's really important in both the acquisition standpoint and the funding standpoint. Start building relationships with the right people as fast
Mhm.
as possible and build the right relationships. Don't necessarily spread your eggs in every basket. Put some eggs in each of the most important baskets.
Yeah, that's well said. Well, and I know we always keep these short, but I want to dig in on the founder side. So you have a co-founder, and I want to talk about that relationship a little bit. You've published this story on LinkedIn a couple times, but just how cool it is you guys built this and how hard you worked. Can you talk a little bit about that?
Yeah. That's Ella Cook is my co-founder. She is the chief operating officer. And she came in June, about June of last year. And, at the time we had a very, very small team. Now there's a lot of people involved, and she's been a huge part of scaling this operation. Um, and she was working alongside an investment bank at the time that I pitched to be on the platform. And she reached out a couple days later, probably 2 days, 3 days later, asking to set up a call. So we had a conversation, and she said that she really believes in what I was building and wanted to be a part of it in any way possible. And I said, well, I can't afford to pay you, so raise some capital for us, and I will pay you, and we'll make that work. And then she proceeded to do that as quickly as I've ever seen. And not only did she raise the capital, she came in and completely changed our operations and standardized things that, I alone was not able to necessarily standardize at the speed. So it was very clear that she was a perfect fit for what I needed, where I could do the technical side, I could do the vision, I could drive things forward, and then she could build out the team, manage the operations, and basically execute on the vision I had. And so she joined, and very quickly we were able to scale the network part and bring on the right talent. We have just a phenomenal team now, and a lot of that is because she was able to find the right people. And we have a global team, people in the United States, but then also people all over. And just the amount of sheer talent, grit, and efforts that everybody puts in together as a team, a lot of that stems from the efforts of Ella. So we're able to scale and scale and scale. And then um, the getting into the story a little bit more, she had to go back to Australia for a couple months because she won the green card lottery, and then she moved to Boston in February, and we got a 2-bed 2-bath in the city. Ella and I's relationship is much of a brother sister type of relationship. We're like best friends. So we were able to basically spend every single waking moment building DFX for the last 6 months until we raised our round. And then since we've been able to move her to Williamsburg, so Brooklyn, New York, where she's expanding DFX further in New York, and I'm still in Boston, building out this kind of headquarters. So it's really been quite the journey over a 1-year period. I could not have built this without her, that's for sure. And we're driving this forward at an extreme capacity, and that's because she is the right co-founder fit.
I love that. Thank you. And yes, I mean, not to say that everyone needs to go live with their co-founder for a couple months to build a product, but it sounds like that was the right fit for you guys. And it sounds like a studio model, honestly. Everyone's in a room and we're working hard, and that's works
It's
very often, more often than not. Is there anything that we have not covered that you'd like to share with our audience of both founders and funders?
I would say, yeah. So as a founder, it's easy to get discouraged when things aren't going your way or investors are turning you down. And it's easy to get discouraged when you're not meeting the right people. Um, I think that one thing to always keep in mind if you're wondering, there's a couple things, but those who are saying no, especially if you're going the VC route and you're approaching VCs, many of them have never built a company. Many of them are fund managers managing other people's money. Now they have extremely strong pattern recognition. A lot of them are incredibly bright. Take their advice in terms of the advice that makes sense to take, but they can be very critical. And in reality, they aren't in your shoes. They aren't fighting your fight. So um, just alignment of who you're around and who you're taking advice from is huge. Um, from a investor standpoint, I think that, in today's society, people can do more with less. So investors are looking for founders who are very, very resourceful, who can do more with less. there's this big push in AI, and obviously AI investing is very hot right now. In reality, what is the best AI today likely won't be the best AI in 6 months. So the founders who can adapt to the landscape are going to be able to be very successful. Whereas we're starting to see the AI companies that received a lot of investment start to fall behind and fail. And so that whole gold rush for the AI market is going to start shifting a little bit. So just as a founder, do more with less, because that's just the nature of the space we're in right now. And I mean, really, everything comes down to a relationship. And that's something that is so important to realize, where a lot of you'll hear a lot of people say the best companies come out of Silicon Valley. And in reality, it's just they have the relationships to get their business off the ground. So that's why they're the ones
Said.
that are quote unquote the best companies. And there's so many great companies that are not receiving funding all over the place because they just don't simply have the network. So how do you have the network? Start building the network, join networks, start to get to know people. And the more you build those relationships, the more likely you're going to be able to get funding, regardless of the quality of the product. So, um, work on clear, crisp, concise communication. Work on building the relationships, and you'll have the success that you want. Just stay hard to it.
Yeah, I love that. Well, and we always end with, what are you currently reading?
Ooh, that.
Of all these hard questions, if that's the one that throws you off. So you've answered everyone. Like, I didn't give any of these to you beforehand, and you're just answers, but then this one.
Yeah, yeah. Well, I have a lot of books right now to read. I this is an interesting question though. So the Museum of American Finance is going in the seaport right behind me, and I'm collaborating with them. And I have a lot of books from Boston-based, basically politicians and things from like the 1800s and 1700s. So that's the
Interest
kind of yeah, that's the kind of stuff that I'm reading right now. It's books that nobody's ever heard of.
Yeah, but interesting though. I love
Yeah,
that.
yeah,
That's great.
yeah, it's fun. That's going to be an amazing, if you're into museums, Museum of American Finance, it's going to be incredible. It's moving from New York to Boston, opening up next year in July, the 250th anniversary of the Constitution. Um, get involved there because that's going to be really cool.
That's fantastic. Well, thank you so much for your time. You have a podcast too, so go check out DFX. Go check out everything that Jesse's building. You will not regret connecting, and I'll put links in the description as we usually do. Thank you so much for your time today. It was really a pleasure to have you on.
Thank you, Mal.